What's up, guys? It is another Friday, the 5th of April. And of course, bring it back around Patrick McCarroll to get into the depth of some things because there is some more bullshit going on with respect to the reports that we get to influence what's happening with the market and interest rates. So what's going down, Patrick? How are you, man?
Good morning, brother. It's good to be back on again, champ.
Well, the way that life goes and yank us a million different directions, it's always
Yeah.
doesn't work in the clockwork style we want it to. But glad to have you back here. I'm glad to have your insight on some of the things out there because I wake up this morning I didn't wake up. I was working out and I'm already getting
Your
pinged
buddy's
with
text message.
exactly bam, bam, bam. The stuff comes. You see this shit. You see this shit, and you're
Yeah.
just hitting it, right? So
Yeah.
what did you see this morning that you went DEFCON 1 on my ass with the text?
So we were expecting the non-farm payroll report to come out this morning. Market expectations were for, I believe, 200,000 jobs to be created. We had 275,000 created in February. So this was the March number that we were looking for. And then once again, I mean, it smashed expectations. So total surprise, totally chopped the legs out from underneath the markets with a big 303,000 print of new jobs created in March of this year. Couple of other pieces, the unemployment rate fell to 3.8%. Hourly earnings were up 0.3%, kind of smashing last month's 1/10 move. But the biggest key is what you and I have been talking about. The average hours worked on the jobs that were collected were 34.4 hours. So I guess we've completely thrown out the idea that a full-time job is a 40-hour-a-week job.
Mhm. I don't even know where to even go with that kind of crap. Sometimes you think about that. It just lends to the thinking of it's all too hard, too difficult
Yeah.
for certain folks. And then to say that that's a normal thing and pushing people into having less, living leaner in a more expensive environment,
Yeah.
it's a mindset shift. It's literally trying to take a person's idea of what things are and shift it. Now, I mean, let's just be honest. We as Americans, we take things a little bit too freaking far.
Mm-hmm.
We are ingrained to just overdo everything. You can't just enjoy finger painting to get your mind clear. You have to open your own damn gallery, right? You
Right.
can't just go running in the morning just to clear your lungs and get ready for your day. You have to decide you want to do an Ironman. You can't
Mm-hmm.
just go work out at a gym. You have to join the CrossFit games. We
Right.
have this thing where you have to do more and more of it all the time because that's how we're built. I
Correct.
can't say that that's a good thing or a bad thing. Me, I can't just do a couple loans and feel good about being able to pay my bills. No, I got to shoot for the top 10 in the United States because you get there one time, you got to stay there. We got this thing. He's
Yeah.
like, I climbed Everest. Well, shit, what's the next one I got to climb? Well, there's
Exactly.
however many summits out there that I want to be able to say I did all summits. And
Yeah.
if you end up dead on there, it's like, well, at least I tried. That's the
Yeah.
world we live in. Right now, maybe it's I don't want to advocate, but maybe it is a good thing to switch back to kind of a little bit of a slower environment, maybe. But the problem with that is what's happening with our expenses. What does that look like?
I mean, we're in a tough place. Expenses have become such a big deal that you can't get on Facebook anymore. And I was laughing about this yesterday with some of our business partners of, these videos of these kids, and I call them kids because they look like they're in their 20s, recording a video with the backdrop, what looks to appear to be their apartment, right, that they're living in, and convincing people that pulling $100,000 of equity out of your home on a home equity line of credit to pay off debt or buy an RV or go buy a boat, do all these fun things because, money's increased, your home value's increased. That's your cash. So you should go get it. And I'm becoming fearful, right, that we're ending up in this place that, we're going to go secure that debt. We're going to repeat a little bit of what California endured. If you remember back in between 2000, 2007, California was basically using home equity as an ATM machine because values were just, skyrocketing year after year. They had such tremendous growth, and then we ended up in a really bad spot in regard to overall health. So the fact that credit cards are at an all-time high and we're going to start pushing the envelope of the equity that we have built up is kind of a recipe for disaster, in my opinion.
Going back to that, pull money out of your home, HELOCs becoming a thing again because the
Yeah.
low interest rates that we had locked in over these last few years. HELOCs they can be a very, very dangerous instrument. Now, I
They
tell my
can.
real estate investors, if you're using it for an investment you can get in and get out of, great. But if it's a long-term thing, there was a lot of guys that were convinced to use those for down payments on homes.
Yeah.
But then what, right? How do you maintain that when you literally financed your property 100%? You're going to put yourself into the same damn issue that we saw in the mid 2000s, where people did that 100% financing and just financially crushed them. So don't do that. Don't listen to people who say
Yeah.
to do that. They don't know what
Especially
they're
on
talking about.
TikTok. Right.
Exactly. They don't know what they're talking about. They haven't seen the cycles. I've been at this since 97. When did you get in the business, Patrick?
October of 97. Yep.
I got in December of 97. We both been at this a
Mhm.
very damn long time. We
Yeah.
both just come from different backgrounds to get there. So one of the interesting conversations we had off camera was what the Philly Fed put out with respect to jobs. Now, we've said here over and over and over again, I've been screaming it for a couple of years now. Every time Patrick's come out, we've talked about this. They're cooking the books on what's going on in our economy. They're not
Right.
telling us the truth about what's happening with jobs, what's happening with the state of things in the United States to make you feel better about things are as they are. They're bringing that confidence up as a consumer, but it's also a negative, it causes a negative response to inflation. They're trying to get inflation under control, so that way we can do some sort of the hope. The plan is to drop the rates, but they're not going to. At least I don't see that happening. But now we have this. So what did you put out this week for us to take a look at?
Yeah, the biggest key to take into consideration is that inflation has somewhat been considered tamed, right? So the Fed feels confident. They don't feel that inflation pressures are going to go up. We're not growing by 6% year over year or 8% or 9% like we saw, at different various parts of the past several years. So the focus has indeed turned to the labor market. There were several Fed speeches this week that Fed members have clearly stated, like, hey, the only thing that we foresee that would lead us to cutting would be a disruption in the labor market. So what you're seeing here on the screen is the Philly Fed came out and ran a report based on the jobs issued from the BLS, the Bureau of Labor and Statistics, and said, hey, this establishment survey here, the BLS overcooked the number in 2023 by 800,000 jobs. So it was high by 800,000. And where that becomes a significant problem is the year before they admitted all as much the same, but that was off by either 1.1 or 1.2 million jobs. I can't remember. So you're looking at a scenario that over the past 2 years,
It was 1.5 million jobs is
it
what
was
they were on.
unbelievable numbers. So you're talking over 2 million jobs that the Philadelphia Fed is saying, hey, the BLS counted this as a job, but they overstated it. Like it didn't qualify. So there's this massive revision. And I think that's kind of where the market's even today, that we blast past it, but we haven't really seen a huge dramatic impact. I think you and I, if we would have gone yesterday and said, hey, this thing was going to miss by 100,000 to the positive, right? That there's more than what was expected. All of these, what would be negative bond consequence reports that came out and the extensions of the report, we would think that we'd be off by, 50 or 75 basis points right now. And I think the market's kind of taken a lot of this into consideration, going like, we really don't know what to believe anymore.
And if you read this article, guys, right here, there's a reference here that it exploded to a big gap of 5 million jobs that currently do not exist, according to the Philly Fed. That's insanity. 5 million, potentially 5 million jobs that do not exist. We got to really, really dissect that even more. I want you guys to take a look at that. But Patrick shot that out this week. Barely got to look at it this morning as we're starting this all up, and that's a big deal. That's a very big deal. If you're getting the world convinced that there's all these people getting jobs and that the market's doing amazing, everything's going as promised by our government, in reality, that's not what's really happening. It means this Bureau of Labor Statistics is complicit in some sort of cooking of the books and then publicly stating it. And now you have the Philly Fed coming out saying, no, that's not what we're really seeing when we do the study that we do.
Right.
That big of a discrepancy, even if they're off just a little bit, 5 million job gap, that could easily be being off. It still could be a couple, 2 or 3 million jobs. That's a lot of freaking jobs.
Yeah. And I think where you get a little bit more unsettled is to the idea that we do have an administration that is touting job creation. Their basis, their slab of support is on job creation. You hear it constantly, right? We're proud. But we're at this place of, you don't really know what the reality of it actually is. And it's negatively influencing the bond market. That's the frustrating part, is if we were getting a realistic approach, and last year, You take the 800,000 divided by 12, that's what, 66,666 jobs, right? Like that would have massively influenced some of those monthly prints that would have allowed rates to be a little bit less than what we're actually seeing. I mean, there would have been some real positive influence to the bond market. So it gets a bit frustrating at times that consumers are getting locked into at these point in time interest rates that are maybe a little bit more elevated than we need to be based on reports that are constantly having these dramatic revisions.
So with you there. So what people don't realize is the more that this stuff gets cooked, the more we're going to see error within the markets.
Yeah.
But what we've got right now, it looks like it's actually kind of settled out fairly well. I would have thought there would have been a lot more movement in the bonds as a result of that. But what we did see a negative open from where it closed yesterday. I'm gonna see if I can zoom in on this. So you got yesterday's close right up here, open just below that. Tried to creep up a little bit, but as the report comes, it came slamming down, bounced off of that, what the general trend line I'm trying to follow here. And it's that's offered some support. We'll see if this support line holds, but interestingly enough, it really hasn't had that much of an influence. It's had an influence, but we're looking at somewhere to the range of 20. So yeah, we're looking probably about 20, close to 20 basis points. Total movement. So,
which I would have expected one of those big red candles, right? And instead of kind of where we are,
I would have thought that whole situation that thing would have done something to the effect of gone, started here, they've gone all the way down to like right here. That's what I've anticipated. Big movement, but we didn't have that.
And what you and I talked about, it feels as though the market is kind of saying, hey, we feel that yields are properly priced. We feel that MBS is properly priced based upon this kind of economic activity, which is good news for us, right? So there's no fear here that we're going to surge back to 8% or we're going to surge back over 7.5% in some cases on best execution interest rates, right? Not when you add the tiers and LLPAs of creative other type products, but on best execution, it feels like the market's kind of saying, hey, you know what? We feel like yields are in the right place based on this data.
And I think that the market's smart enough to start carving through some of this stuff, and they already saw this report more than likely, right, from the Philly Fed, and they're looking at today's jobs report. Can't really say that this is real, right? They're going to be a knee-jerk reaction because the markets are emotional. Right. The second something happens, somebody's going to jerk the trigger real quick, trying to get ahead of the next guy who might be jerking the trigger. Few people jerk the trigger, then they have to wait and say, we're actually good. This trade's not going to play out the way we think. So we're going to go ahead and flip this back the other direction, get back in. And that probably is what stopped a lot of that movement that would have happened, because a little bit of, I would imagine some restraint started to kick in, a little logic kicked in away from the emotion. And that's why we didn't see the big movement.
Right. Right. And kind of what you can go to the usdebtclock.org, right? And they show a lot of employment data there, and you can kind of track and watch some of it. But if you look there, the number of employed Americans in 2000 was 161.1 million, right? And then as of today, it rests at 161.2. So in a 24-year time span, you're really only talking about 100,000 additional jobs created in the past 24 years, right? So it's this ebb and flow of, are we creating jobs, or are we still just filling the gap of jobs that were lost through COVID? And it sounds like the answer is the latter.
Sounds like more of a gap situation, not necessarily increasing our labor pool. Then, of course, you have that old report that we had last year where they were really cooking the books and trying to take into consideration population growth from immigration, and they've got to be working somewhere and all these things. Well, if you don't have actual data on the jobs, I don't know how you can report it or you can count it. And then, of course, we do know the influx of immigration, illegal immigration. I think the only jobs that should be creating is those law enforcement jobs to keep and deport and get that back under the way that it should, but that's not happening either. So we're losing those jobs supposedly to create something else for a general labor market. I don't know exactly how they're coming up with that, but it is definitely cooked however that is. But back to these charts. If you're like me, I'm thinking we're higher for longer. I see this slowly working its way through these support lines and working our way back down in this big open void, as we can see how much movement happens up in that big open void. Any thoughts you have on that?
Yeah, I think we're in that space. On the report that I have marked with you guys, particularly on the MBS 5.5, we're in those three different tiers. If you see kind of there at your bottom, there towards the left and at your top, and when you kind of walk through those, I really feel like we're in a sideways trading pattern from here until, we get to a place, not to say that rates are not going to fluctuate a quarter to a 0.5% here or there. I think there's a real possibility that we're going to bounce somewhere around 6.8, 6.9 to 7.1, 7.2. If data all really remains the same and consistent all throughout the rest of the year. And I still think there's a reality to the idea of what the Fed's been talking about, of the fear that the economy is still resting on the lowest inventory available homes for sale in history, right? Like, so there still is not enough there. And then you have that paper that has recently come out that I sent you guys, the nerdery of that, of the lock-in effect and how that lock-in effect is affecting inventory and sales for the future. So again, the reality then points back to, if rates were to fall to 5.5% right now, and we were held on supply channels that we have that are available, you're going to repeat 2021 all over again. The supply is going to be eaten within seconds. People are going to come out of the woodwork. Property values are going to grow somewhere between 10 to 20% annually. And it would literally price a specific number of Americans completely out of the game, maybe forever. Right. So there is some reality to the idea that we still can't let interest rates fall to a massive level to kind of say, hey, we've got a bit of a problem. And the Dallas Fed talked about this briefly in a report that they issued. And I put it on Facebook, to where they said, hey, lower interest rates don't necessarily help affordability, because what their report is saying is, look, prices are growing at such a substantial level that even if interest rates were to fall to 5.5, and it took us 2 years to get there, we see home values, we being the Dallas Fed, we see home values growing at 7% annually. So when you come back 2 years down the road and prices are 14 to 15% higher, even with the reduced interest rate, you're not going to feel it as much.
Yeah. And what we've seen is, no matter what the interest rate ends up becoming, guys, if it goes down, you're going to pay for it in the cost of the house. If it goes up, you're going to at least be able to get a few people out of the bidding pool. We're still going to see home prices go up because of inventory. It's just the way it's going to be. They're not building enough homes. And I think they're holding back because people are freaked out that there's some sort of bubble that there really isn't. There's still a demand. There's still a lack in supply. So any final words you've got?
No, I mean, it's, I think we covered all the basis this morning. I mean, I think we're going to remain in this sideways pattern. If you're looking to get into property as a homeowner, you're looking to get in as an investor, it's still a phenomenal opportunity. I mean, we had an investment deal this morning where the appraisal came in $25,000 above the contract sales price. So there are some definitive deals out there in real estate right now to really create a positive impact to your net wealth.
Do not allow what's happening in the market to stop you from continuing to grow your portfolio. If you start getting a little bit apprehensive, a little bit scared, not sure what you're doing, call us. Right. You've got my number. You got my email. You've got my website. Get on there. Let's figure this out. Thank you, Patrick, for always being willing to add a little bit color to what's going on out there.
You bet, champ. Have a great day.
Thank you.